Okay, so in this question we're looking at a company that is innovative and produces products that are environmentally friendly and sustainable, and it's looking at a new project. And we're given some financial details of the new project, and in addition a follow-on project. So this is a real option to follow on. So we've got the UR project, the Jigu project, and to complete the set we've got an option to abandon the UR project by selling to a company called Honua. Okay, and then we've got various bits and pieces and the requirements. The key point with this question really is the need to plan. This question is confusing. It takes a while to get your head around what's going on, and we would generally recommend about 20% of the time, so about 20 minutes, invested in planning and understanding and getting a sense of direction about which bits of the question relate to parts A, B, C. It's not fixed in stone that you should spend 20 minutes planning. You might find that after 10 to 15 minutes you're just ready to go, in which case that's great. But you've got to have a good understanding of the differences between these projects and how the information in the question relates to the requirements. So clearly in part A it's a general discussion of real options, but it's how real options can help this company, so you've got to be slightly careful there, because I think you're going to have to discuss the actual real options in this question to get a good mark in part A. And then in part B, before you start writing your reports, you've got to be very clear that part 1 is the MPV for the core project, and then exactly what part 2 is about, and that's in the detail. We'll get into that in a second, but it's very easy to answer the wrong question in part 2, and it's easy to miss in part 3 that you should be doing two things: assessing the project and also the assumptions. And finally in part C, it's quite easy if you rush it to miss the need to discuss the impact and give advice on biodegradable drones. The professional marks should fall naturally out of a well-written answer, and we'll address them briefly at the end of this analysis. And in the analysis we are not going to be covering every point. We are going to be covering the key points, and we will say something about each aspect to the question. Part A we'll look at very briefly. In my plan I'd be copying in the requirement words, and I would be multiplying the technical mark allocation by 1.95, and that means that I'm going to allocate about 10 minutes of my writing time to this discussion. And broadly I'm going to discuss what real options are. I'm going to define them, but I'm picturing that as being worth the mark. Clearly this is a lot more than just saying what real options are. I'm going to define real options and say why each can be valuable, because that's answering the question. I'm going to relate them to the scenario where there's an option to follow on and an option to abandon, and I'm going to talk about the overall approach of real options capturing the value of volatility and of flexibility. And you've got a solution that does that, and I'm sure you've read that already. If not, I would refer you to it. So we're trying to apply our technical knowledge to the requirement and to the scenario. Now looking at part B, we'll look at the report format and other aspects to professional marks in a minute, but let's have a quick look at B part 1, where we're doing the NPV of the UR project. So with the MPV, most of the numbers are fairly straightforward. In terms of approach, I would have a working section, working 1, working 2, working 3. I would complement it with a brief notes column showing basically what I've done in each working, where that's helpful to me or the marker. And then the calculations here for price, variable cost and working capital are all fairly straightforward. Price is inflating by 8%, as you can see at the top of the screen. Variable costs by 4%, and working capital is a percent of revenue in the first year, 20% of revenue, and then it's 10% of the change in revenue. And these are changes in working capital that I'm calculating. Then in terms of the NPV, I'd have a neat spreadsheet. I find it helpful to have the volume just above the time period because it's a constant reference point in this sort of question. And then my revenue is my calculations in working one multiplied by volume, and the same for variable cost. And then I'm just going to copy those over into the other time periods. Training is a percent of fixed cost. Fixed cost is going up by 10% per year. And the tax allowable depreciation, we're told, is straight line 15% on the 35,000 initial investment. And then in the final year, if you look at the workings at the top of the screen, I take my 35,000, I subtract the 3 tax allowable depreciation amounts that I've got, I subtract the scrap value of 7,000, and that leaves me a balancing allowance. Tax allowable depreciation isn't a cash flow, but it's relevant for the profit calculation. Tax is then 20% of the profit figure, and the profit figure is negative in year one, so that's a tax credit. In some questions, that tax credit will be carried forward into years where you're profitable, but in this question we're told that we can use any tax losses immediately. Then the working capital is just the working capital change, which is positive, that I've calculated earlier, but any increase in working capital is a negative cash flow. I get positive cash flows when working capital starts to be run down in time periods 3 and 4, and in time period 4 I have to add up the previous time periods to see how much working capital I've got, and then that's all released in time period 4. Then I add back the tax allowable depreciation, I deduct the outlay, I include the residual value, and I net off. Once I net off, I use the NPV function. You can see at the top of the screen, equals NPV, open brackets, cost of capital, highlight the relevant cash flows, and that's everything from time 1 to 4 dealt with. I then subtract time period 0, and I get essentially a very, very small negative NPV. And that's B part 1, which is all about estimating the NPV. And I would have a brief comment at the end to say that, ignoring the value of options, this is a project that would be rejected because it does not give a positive NPV. In other words, it gives a return of less than 11% cost of capital. So B part 1 is the biggest requirement, and it's all about being neat, well organised, having a clear working section and notes column, and making it easy for the marker to see why you're doing what you're doing, and you should be able to pick up good marks in B part 1. B part 2 and 3 are, I think, harder because they require more careful thought in terms of what you're being asked to do. So in B part 2 we're being asked to address the requests made by the finance director about 2 things. The asset value for the Jigu project and the estimated value of the Hanoa offer 2. So let's look at the first of these. For the Jigu project, where does the 46.1 million asset value come from? That's what we have to focus on, nothing else. So we're not doing a standard option valuation here, we're just picking on that variable of 46.1. And what we're told with this is that we've estimated that the NPV at the start of the project is going to be 10 million. And what that means is that if you disregard the amount spent to exercise the option, then the inflows have got a present value of 70 million, and then you deduct the outlay and you get the 10. And that is 70 million in so this at the start of the project, and the Jigu project happens after the UR project. So I'm saying in 4 years' time this is going to happen. So I'm really hoping that I can get the asset value by discounting 70 million for 4 years at the cost of capital, which is 11%. So if we do that calculation, I've got the 70,000 present value at time 4, and then either using the tables or just using my own discount factor, 11% over 4 years, and then 70,000 times the discount factor gives me 4611, and that is the correct number. And if it wasn't, I would play around with the numbers until I got there, or I would just move on. But that's where the number comes from. The second thing that B Part 2 asks us to do is to look at the finance director's request for the other option. And here we have to recognise that this is an option to abandon, so we're valuing a put option. And this requires us to just use the Black-Scholes option pricing model spreadsheet that is given. And actually, the first variable in that spreadsheet will be the 30 million, and that will be the exercise of the option. This is at the start of the 3rd year of the project. So if we exercise the option, we would lose the 3rd and the 4th year of the UR project. The 3rd and the 4th year cash flows define the value of that asset at that point in time. So to work out the value of the asset, I need to take the time 3 cash flows. If I just go back to my calculations, my time 3 cash flow was 23,193, and I need to discount that back at 11%. If you look at the top of the screen, you can see the formula building up to the power of 3, and that gives me 16,959. Same approach to time 4. Add the numbers up, and that's the value of the asset at the point where we're considering abandoning. So my actual spreadsheet, which you're given, would have that value highlighted in yellow, the exercise value, the risk-free rate, the time period, that's in 2 years' time when the option would be exercised. The standard deviation, easy to miss that, but it was given in the question as 30% for the Jiggle project, and the spreadsheet does the rest, and we'd simply pick up 2.4 million as being the value of the put option. And then in B Part 3, you've got lots of opportunity to talk about the assumptions. Not only assumptions like volume and disposal value in B Part 1, but also the general assumptions used behind the Black-Scholes option pricing model, which you could refer to in B Part 2. My interpretation is that the two options are not mutually exclusive. If you do the first project, then you could do the follow-on even if you sell to Hanoa. Different interpretations are possible, but that's going to define how you look at the overall project plus the real options and come to a reasonable conclusion. And then finally, in Part C, the key point really is that what we're looking at here is a two-part question. You should split up your answer into at least 2 areas. What's the impact and what is the way of handling these issues? And we're picking up clearly mainly here on the detail in Exhibit 4. And so you're going to get credit here for a discussion of the impact of pricing being too high, the image issues, the possible impact on profit, and also the issues connected with the supply base in Dunia. On the one hand, you're already there, so is there any further reputational impact? On the other hand, clearly there's some possibility of your image being damaged and of being unethical by knowingly encouraging child labour. How to address? Well, this will just be a practical discussion. You could sell the idea. You could, rather than invest in unethical companies in Dunio, you could narrow the supply base and try to support education or support working practices in that narrower supply base, and so on. You're going to get up to 2 marks per well-explained point in this type of question. And the professional marks, well, for communication, you want to have a report format with headings, with clear references to your spreadsheet calculations, a brief introduction and a brief conclusion. For analysis, it's all about how you're using the numbers. What do they mean? How can you use them to support a meaningful discussion? Skepticism, well, this could be over the valuations of real options, because there are big problems with Black-Scholes option pricing model. And commercial acumen, or perhaps mainly in part C, there are opportunities for saying practical, logical things about how you could handle this situation. So there's no magic fairy dust for professional marks. They're a reward that will be generously given for good quality relevant thinking in the technical parts of the question.